This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you're listening to episode 77. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@SNN.Wire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. For this episode of the Planet MicroCap Podcast, I spoke with Doug Mohn, editor of NoCalledStrikes.com. I met Doug recently at the MicroCap Leadership Summit in Chicago, and I enjoyed getting to know him, as well as learning about his experiences regarding investing in microcap stocks. What is interesting about our conversation you're about to hear is that, unlike most investors, Doug doesn't mind illiquidity. In fact, finding revenue-generating companies listed on the pink sheets is part of his criteria. Like most of the interviews you've heard on here, most guests have said in one degree or another that there's a natural edge when investing in microcap stocks because most institutions can't and won't get involved until these businesses have matured. I would argue that Doug takes this notion a step further by looking at illiquid stocks that generate revenues on the pink sheets. Most investors don't even start there. The goal for this interview is to learn more about Doug's investing strategy and his journey looking for winners on the pink sheets. Thank you again for tuning in to episode 77, and I would like to welcome Doug Mohn, editor of NoCalledStrikes.com. Doug, welcome to the Planet MicroCap Podcast.
Thanks, Bobby. It's, great speaking with you again. It was wonderful meeting you in Chicago a couple weeks ago at the MicroCap Leadership Summit.
It was great meeting you as well, and I really appreciate you taking the time to come on to the program here today with me. So, to jump right in, get started. What is your background, and how'd you get your start investing in microcap stocks?
Well, my background's pretty different than a lot of the folks that you meet or you might be interviewing. I'm a regular person. I had an IT job with a large oil company for 20 plus years. Prior to that, I actually had a petroleum engineering degree and graduated in the oil bust of the 80s. And I'm in my mid-50s. And about 5 years ago, I was able to retire from my day job and just spend my time on full-time investing. I've been a serious part-time investor for about 20 years. And a few years ago, I got to a position where I didn't really need to go into my day job anymore, and that opened up more time to take my investing a little bit more seriously. I had an interesting start in that 30, 40 years ago, I would see my dad's stock reports, or he was kind of an old-fashioned investor in the sense that you would have the shares. This is all in the 70s, pre-electronic trading, and 3 or 4 times a year, a dividend check would show up at the mailbox. And of course, you have to realize these were quite small stakes, so it might be a dividend check for $8 would show up or $12. But hey, how's this money coming into the mailbox? I thought it was kind of interesting. And so I kind of always had an interest in how that kind of worked, and I played a lot of stock market type games when I was a kid and just found that all very fascinating. And then after I had my own job and started saving money in the 80s, I dabbled with a few things, and I found Peter Lynch and read his material. That was the first stuff that really deeply resonated with me. And then in the mid-90s, I had a much better job, and I started reading Warren Buffett's reports, and that totally hooked me. Mm-hmm. And then I worked in Angola, West Africa, helping Angolans build a computer network, and that had a nice overseas premium in the job. And so that kind of built up some savings that I was able to then invest. And so early on, my investing was really focused on large cap stocks. I had read about all the evils of small cap stocks and didn't want to have anything to do with that. And as I got better at my investing, I realized there were opportunities in these small cap stocks that I had just casually turned off to the side because I'd heard all these bad things about them. And I got more confident that actually there were some good values in there. Well, once I started digging into that space a little bit more, I realized that's exactly where I wanted to be, because the basic premise of my investing is I want to buy things that really smart people would buy, who have lots of assets and have lots of resources. But frankly, they can't buy because they have too much money. If you're managing $10 billion, you can't buy something for $100 million. Sure. That's too small. It doesn't make a difference to your portfolio. So if I'm buying into a company that has a $100 million market cap, I don't have to compete against really smart people. The best and the brightest with the greatest resources can't touch this space. And so there's a whole network of interesting folks who are not associated with massive hedge funds that look into these kind of stocks. And I'm one of those folks because our assets are small enough that we can buy a position that maybe trades a couple thousand shares a day. Mm-hmm. And it's very meaningful to me.
Yep. Well, it's true.
But it doesn't mean anything to Bill Ackman.
Sure. Yeah, no, it's trivial like that, right? You know, the people that, you know, are coming out of all these Ivy League schools and have all the resources available to them. You know, it's not that they probably don't want to, they just can't, you know, because they just have too much capital that they need to then deploy. And, you know, it's an interesting part of our space that, you know, I think most of the people I interview on here find as their edge or the competitive advantage and being able to find some interesting ideas. So, you know, but before we get into more of your process and your strategy and really why you got, and even more in depth on why you got into microcaps, you know, when we met, you told me a little bit about nocalledstrikes.com and your blog, and I know I've had a few people on here like the Brandon Mackeys and even Ian and MicroCap Club for that matter, who decided that they wanted to, you know, talk about their positions so that they, you know, it helped them in their process of developing their thesis for why and their conviction for why they wanted to potentially buy or sell, or, you know, just, you know, talking about their positions. So for you, you know, why did you, you know, firstly, well, what is nocalledstrikes.com for those who don't know? And then why did you start this blog?
Nocalledstrikes.com is my investing blog. And my reason for it to exist is that reading other people's blogs is a big source of my ideas, mm-hmm. and gives me a lot of insights into things to chase down. And so if I go to an investing conference, I generally like to write up one of my more interesting investments at the time in some kind of format that I can then share with people. So if I give you my elevator speech on a company, I can then refer you to the blog for a little bit more detail. I find that writing is incredibly helpful because in our brains, we're able to make every investment look really positive and desirable. But in reality, almost everything we buy has some kind of flaw in it. There are very few absolute slam dunks that don't have some kind of issue. Even if it's a slam dunk, there's probably some issue about whether it's a 3-point slam dunk or a 2-point slam dunk. There's always some kind of issue, and nothing like getting it down on paper. I also find that I don't publish as much as I would like to, because I find that I only want to publish things that I have pretty strong conviction in. Mm-hmm. Because once you put it out to the world, it becomes there's some confirmation bias that starts taking effect. And a company I wrote up about a year and a half ago, Contour Energy, which I owned then, later sold, and then got back in about 6 months ago and still have. When that one came out, about a month later, I came across a new IPO that was coming out from Warrior Met Coal, ticker HCC, which I've never owned. And I decided that actually I liked that company a little bit better for its investing, but I had already kind of mentally invested so much of my energy into the other company that in hindsight, I believe that my public commitment had kind of blocked me from more nibbling, moving over, or at least diversifying into the other investment. Mm-hmm. And so I think there is a little bit of a risk when you talk about your stocks in public that it confirms you in. But if you pick a pretty good stock to talk about, then you don't have that much to worry about. But I find writing really brings out the risk and also makes you challenge your numbers a little bit. Mm-hmm. Most of my investing is at the level of a cocktail napkin. If I can't make a convincing argument for a company on the 3 or 4 basic calculations, it's not for me. Mm-hmm. I admire people that make fancy 20-page Excel workbooks, but really, if you think you know these variables down to the 10th, or if you know that what the margin is going to do 3 years from now, you're a magician. You're fooling yourself. So much of investing, once you get past the basics, is staying rational, emotional control. And it's so easy to talk yourself into an investment if it passes a couple of your filters. I'm always looking for something, first and foremost, when I buy something or I'm considering buying something, you have to ask, why is this opportunity available to me? There's several million people investing at any given time, or there's at least a couple 100,000 people on Wall Street representing 50 million pension funds, or 50 million people through different pension and retirement investing accounts investing on your behalf. They all have greater resources, more staff, bigger databases. Why me? Why am I so lucky? And so I like to look for things that I don't feel I have to be that lucky. It's just that previously, like talking about the low liquidity stocks or the small cap stocks, they're too small, or they don't trade enough to attract the attention of other people, in which case I feel like I have a legitimate advantage. Mm-hmm. One type of opportunity I really like is stocks that are perhaps trading on the pink sheets, or they are unlisted or off a major exchange for some reason, and they're in the process of uplisting. That their historical accidents are why the opportunity exists, and that gives me a chance to jump in and buy something that other people would agree is a good investment, but they are perhaps restricted from buying low liquidity stocks. They're restricted from buying things on the pink sheets. Mm-hmm. And so I can get involved in that. Or that perhaps they're another source is companies that aren't in index funds. If something trades on an index, it has a large following, and if it doesn't trade on the index, it's likely to be off the radar of large funds that are index huggers. Mm-hmm. Conversely, though, one of the things I really like is when you buy something or are looking to buy something that is in an index fund, and because it's in the index fund, a lot of the volume trades not based on the merits of the company, but because of how that index traded that day. Mm-hmm. And so you get a situation where the stock moves without rhyme or reason to its fundamentals. I always like those kind of situations.
Mm-hmm. So I really want to get into then your discovery phase. How do you go about finding, potential new ideas before then you dig into them with your criteria? Because it sounds like you have like a hybrid of, you find it, on your own, but also you like to see what some of the microcap institutions are doing or not doing for that matter. And then going from there. Am I kind of on the right path there?
Oh, absolutely. I don't find that many ideas just from myself. Maybe every third or fourth thing I buy is something that I would consider purely sourced from myself. But most items are things that I've heard about, I've seen, following other people's annual reports or quarterly reports, looking for something that is similar to what someone else has just talked about. Maybe that's considered sourcing the idea myself and not taking it from somebody else. But there is no, in the small cap space, there's probably 300 companies worth following at any given time that are in my wheelhouse. And it's inevitable that some of those are going to be also followed by some of the same people you've had as guests on your show. And one of the great things about investing, now that I have gray hair and I'm in my mid-50s, is that all this knowledge is cumulative. And so I will see companies pop up on my radar that I have I might have learned about them in 1995, 2005, and it gives me a tremendous advantage to see something pop up and I have a basic understanding of that company, and then I can jump into a few current details and make a back envelope calculation. Because if you're buying something that maybe only trades 2,500 shares a day and good news comes out on it, you have a window of 2 or 3 days in the small cap space before that probably reprices to an updated value. And if you can buy it the next day, you can still get an attractive price. If you have to wait a week, even in small caps, the market is somewhat efficient. But I can't do that without having the knowledge of from the previous story. I'm like, oh, I always thought that would be really good if they got rid of this bad part of their business, or if someone actually bought them, maybe there's a real chance for a value realization to occur and it's not fully priced in yet. That doesn't happen too often. Mostly what it helps on is I kind of know, hey, if that's happening in one place and to one company in this space, maybe I should go back and look at some of the other companies that were in that area that I haven't been looking at for the last 5-10 years.
Mm-hmm. Okay, so then, yep.
I'll just jump in and say I especially like when I'm talking to younger investors who may be fresh out of college or still students, and they're like 25. And I'm thinking, you were in junior high when this company last had its day in the sun, and trust me, you weren't aware that this company has history, and the people I'm talking to don't know its history, and I feel like I'm at a competitive edge in those kind of situations. I would toss out, and conversely, sometimes I'm scared off by things because I know of its history, and perhaps a younger person, without having that concern, is able to just focus on the good things that are coming up for the company and not worried about the past. But given the choice, I'd rather know what happened in the past versus not.
For sure. So my next question to you is, in terms of your criteria? You kind of already went over it a little bit, but let's try and summarize it all when it comes to what you're looking for when you're evaluating a potential new investment.
Well, first of all, I have a value bent. There are a multitude of ways to make money in investing, and they all work. So if someone says the only way to make money is by buying high growth companies, or the only way to make money is to buy deep value, they don't know what they're talking about. There's quite a number of successful people in all different areas. I find what's really important is to stick to the style of investing that resonates with you, because there will be times when things are good. And I find that I'm really good at handling upside volatility. It doesn't faze me at all. My stocks can go up, and I'm quite happy, and it doesn't make me nervous at all. But they go down, and I'm human. I don't like my stocks to go down. But if I really know what I own, and I feel very comfortable that that company is doing the same business today as it did last month, who cares what the quote did? Mm-hmm. If its future looks as good as the past, or the projected future, all the milestones are coming up the way they're supposed to, downward volatility is a great thing. It's a great chance to go add to your position. Mm-hmm. I can only feel that level of comfort if I understand what I have. And if I'm counting on a lot of great things to happen in the future, I don't get that same level of comfort. Now, some people who are better at visualizing the future than I am can buy those things and say, honestly, this video on demand thing is going to be great, and everybody in their next door neighbor, it's the only way they're going to watch movies, and Netflix is going to be like not just in the U.S. but everywhere. And God bless those people; they make a lot, they make a lot of money buying companies like Netflix, which, for disclosure purposes, I say I've never owned, because I was never smart enough to see that it could take off and make its own content and do all that. And who knows how its future may play out? I still think it's really highly valued, but for people who work in that space, it's great. But that's not my space. My space is much more, this is a nice, dull, boring company, and it's going to stay boring, and no one's going to come into this space because it's boring, and it will continue to grow just like it has in the past, or it's going to continue having the business it's had in the past, but the future is going to be more stable than it appears. I own a couple rural telecom companies, which are about as boring as things can be. They're slowly melting ice cubes, but they're very slowly melting ice cubes, and they generate a lot of cash, and I feel pretty good about them. So I have a natural inclination for things that are a little bit more on the safe and secure and boring side. What's good about boring is the stability. I'd rather read about something that's more interesting, but I like this. Doug, I like the stable stocks.
Well, what's interesting to note here, because I think a lot of people tend to associate, revenue generating businesses with being listed on a national exchange, or, even at the very least on the QB or the QX, you know what I mean? But, you said earlier that you actually prefer something that's listed on the pinks or unlisted, and they're maybe doing an uplisting and low liquidity. So maybe talk about that experience, how you actually, it sounds like you go for the same old boring, companies that are generating cash flow, potentially even, profitable, but that are also on the pinks, so that might be an interesting thing to maybe, demystify in a sense.
Sure.
There actually are some of these companies on the pink sheets.
Well, what I ideally like is to find them on the pinks and then have them move over to a larger quote service, because they've reached because they outgrew their position.
But moral of the story is they're there.
Yeah. And so you're able to get them at a better price because they're obscure and they're hidden. And a lot of people, and for darn good reason, big funds can't buy these stocks on the OTC because they need a $100 million position. Well, you're not going to get a $100 million position in a company that trades $20 million of stock in a year. It just doesn't, you can't do it. And so that is a world of opportunity for individuals or for small managed accounts and small investing firms. And it checks all my boxes because there's no problem with the quality of the idea. The problem is the quality, the ability to purchase and to build up a position. And if, unfortunately, my assets are still at a size where I'm not priced out of these markets, call me in 10 years and I'd love to tell you that, sorry, I just can't buy that stuff anymore. It's too small for me, but I don't have that problem yet.
Not in 10 years, you're going to be like, I have a family office now. I just can't, So,
but tell you what, that's what I would suggest your college students to buy into that stuff. Oh, I think there's a whole history of people who have started in that space, and then as they've gotten more successful and taken on other people's money, they eventually have to move out of it because the opportunity is too small.
Well, Doug,
but that's a great space.
Yeah. Well, Doug, let me ask you, because I would assume, I've come across some, in our space and, doing interviews and, with companies that are listed on the pink, sometimes they're not as wanting to get their message out there as they'd like. So it could make the due diligence process a little bit more difficult and harder to find information on companies that, may have revenues and just aren't on a big exchange, but finding that information that you, as more of a value-oriented investor, want to get all that information. So in your experience, what's been the due diligence process like for you? I mean, are you still, I'm sure you come across management that is willing to talk, some that aren't, what's been your experience like?
Well, this actually brings up a couple issues, and it's becoming more important for the small cap or the nano cap companies to be better about providing materials and doing some of the listings on the OTC market, because we're having trouble with some brokerages not allowing us to purchase securities from OTC listed companies unless they meet a certain level of certification. And so it's actually it's a double-edged sword, as companies like Merrill Edge or Fidelity don't let you buy opening positions in certain lightly traded stocks. It's a pain in the butt because you have to go open an account at another brokerage to buy these. On the plus side, it keeps my competition at bay. Maybe they don't have an account at the other broker and they can't buy those securities, so it's less people I have to compete against. So it's good for me, but it's bad ultimately, I think, for the companies that need the markets. And I think it's bad for, I don't want to sound too highfalutin here, but I think it's bad for democracy and bad for America that we don't have better access to these companies, and don't. By having more companies with public listings, we have more transparency into the business of America, and the wealth that's generated by these small companies goes to a larger swath of individuals rather than all get tied up in some kind of private equity firm. End of political soapbox. But what the small companies can do is, I think they have to break down and put out a little bit more information on their stocks so that they get the higher level of listings off the OTC markets, and then they get the approvals from the more gun-shy brokerage houses to transact in their stocks, and that helps everyone. There are companies that are dark, that is, they were once public and then they've gone off the market. They no longer report to the SEC, but they're still tradable. And some of those companies still produce respectable annual and quarterly reports and put the information out there that you need to make a reasonable investment on. And I'm very happy to buy those companies. There are other companies that go dark because their intent is to keep people away from their secret. And if you have a strong enough hunch on what their secrets are, they can still be worth buying if you're very patient, because they may take a long time to reveal their end game and cash in their hidden assets. But on the other hand, if the management of a company doesn't really want you around, I think you have to give a lot of thought to not being, part of their game. If they don't want you with them, I think you're going to enter a world of frustration, and it's best to be alongside somebody who has a much more pro-shareholder mindset. I think will serve you well in the long term.
Mm-hmm. So that actually leads to my next question, because you mentioned earlier about, you sometimes like finding companies that may be on the pinks or, that or under the radar, so to speak, that maybe had a historical accident. So rather than asking what the historical accidents were that led them to where they currently are today, what are some, I'll just call it accidents that you see microcaps do that, definitely that make you be like, all right, I'm not touching this with a 10-foot pole?
CEOs that are taking whopper salaries that issue lots of options. That's a quick way to chase me out of the game. I think small cap stocks, especially the microcap stocks, in general, get a bad reputation and are painted with a very broad brush when there's quite a number of good companies in there. But hey, there are some bad operators out there, and there are some people who are managing the business as for themselves and not for their shareholders. I think you have to look at when I'm assessing a company for the first time, one of the questions I'm asking is, how does the CEO or how do the largest shareholders get their money out of this company? How do they plan to make money on this company? And a lot of times, brand new investors don't appreciate that there are other ways to make money besides the stock of a company going up in price, and that they think that everyone's whose CEO is going to treat you like Warren Buffett treats shareholders of Berkshire Hathaway, and nothing could be further from the truth. I invested in a company that I thought was had a reasonable opportunity to do well, and I started realizing they had financing that they were using, which in itself was not a problem because the business was in a transition and was in a risky period, and so it had to pay a lot for its financing. But the longer I looked at it, the more I realized that insiders were doing the financing, and whether the common equity holders would do well or not, the people who were offering the high interest rate financing were almost assuredly going to get their money back and get the high 18% yields. Well, all they needed to do was keep the business alive, and they were going to make good money on the money they were loaning to the company. Myself, as a common equity holder, was only going to make money if the equity did well, and so I had this misalignment. And I see that more often in a small company, because in a small company, it's easier for the insiders to control the controlling asset. If it's a $200 million company, you only need $101 million in the equity to have majority of the vote. If you're running a $10 billion company, you need to have $5 billion and $1, and that's limits the pool of people who can do that. Though I would say if you look at some of the big reorganizations that have happened, Sears, I didn't say that. I've never owned Sears. I thought about shorting it many times, but I've actually, it's aside to say that lifetime, the total of all my shorts has been a negative realization. I had been better off if I'd never learned that button was available on the trade sheet. And it's not because I was wrong on the companies. It's because shorting is a alternate universe where the rules of logic don't apply. When something is trading for twice what it's deserving, it doesn't mean it should necessarily go back and trade for 1 times its value. It could, once you've left the realm of logic, why not trade for 10 times what it's worth or 100 times what it's worth? It really doesn't matter. And eventually you'll be caught in a situation where you risk having to get your shares called back in because you don't have control over the shares that you are shorting. And so you decide, I better just take my loss and move on, even though if you could have held out to that position 99 times out of 100, you have been proven correct. So that's a space where I've learned that I'm not suited for that. There are technical reasons it doesn't work. And also that's a case where what I'm comfortable with, if I buy something as a long position and it moves against me and I really know what I own, I see a downturn as an opportunity to increase my position if I haven't bought too much already. I don't want to go too crazy on the oversizing. Whereas when you're short, you get into this unreality land where you're disconnected from reality, and goodness knows what will happen next. So bless those people who have ice in their veins and can watch something move against them by 10x, but that's not me, so that's not my space.
Gotcha. So how about, as a retail investor, one thing I always am curious about, and that I know my audience is curious about, is your experience as part of your due diligence process is having access to management and your willingness to want to talk with management teams. I know you do because I saw you. Of course I saw you in Chicago, so you were at the meetings and you were asking CEOs some questions on CEOs of companies. But when you're at home and you're part of doing your daily routine, what is your experience like and as part of that due diligence process in talking with management teams?
I am very careful about my interactions with management. I do attend a couple of conferences every year where CEOs or CFOs are made available. And 9 out of 10 CEOs are really great people that you'd love to have as your next door neighbor. And they're natural salespeople by and large. No one gets to the top of a company, even a small company, without an ability to schmooze and make you feel comfortable and present their position well. So you're dealing with people who have a very optimistic, passionate style, and they're going to make you feel comfortable and address your concerns the best they can because they're really good at it. That's why they got to where they are. So I'm not looking to those individuals for a great insight on, hey, what's third quarter of 2021 going to look like? I'm trying to see, hey, does this person have a good understanding of capital allocation? Is this person spent 15 minutes talking and all they care about is absolute growth, but no apparent appreciation for growth per share? Do they talk about per share values, or do they talk about when we get our next funding round, we'll have the money to advance, to build our next factory? The more they talk about funding, the more worried I get, and the more they talk about the passion and the unique proposition that their company provides, the more interested I get. And so I'm trying to learn what it is that they know about their product or their market and the space that they work in that I don't know, and how that will help me. But if I just listen to CEO buy 4 out of 5 companies where I meet the CEO. And that's not my ratio.
Wait, say that one more time.
If I was just if I just made my purchase decision based on meeting the CEO and hearing them talk for 10 minutes, I would probably buy 80% of the companies that of the CEOs I listen to. I'd be like, dang, that sounds great, man. I can't wait. This stuff's awesome. And then I get back and I find like, oh, this would have been more awesome at about 10% the price,
Right.
Too bad I didn't hear this guy last year.
That's funny.
But it's very valuable. My favorites are the founders, the people who have been with the companies for 20 years, and they know the product backwards and forwards. They haven't been brought in to do a quick fix and clean up job. They have a company that maybe it's been in the family a long time, or maybe the person founded the business themselves 15, 20 years ago. And maybe that's why it's public, is because it was created at a time when more smaller companies were listed, and they found their niche, and their niche is underappreciated, but it offers a pretty compelling value. Now, a lot of those companies aren't set up for the multi-baggers. I know a lot of the microcap people are always on the quest for a 10x and a 100x, and that's a very legitimate way to invest. If you're looking for the 10x investment, you're probably much more willing to suffer a lot of goose eggs than I am. I don't really like to buy things that are going to go to zero, but I'll be the first to agree with you that if you buy 10 stocks and 9 of them go to zero, but one of them goes to 50, you're going to do a lot better than me. And that's a perfectly great way to invest, but you have to be comfortable with that. When I try doing something like that, I find myself getting frustrated that I own these things that are going to go to zero, and then I get rid of all of them, including the one that actually turned out to be pretty good. Ironically, I think this is all emotional on my part. I think if there was a closed-end fund that owned a combination of those, and I had no control over its composition, but if you told me that you have a closed-end fund with 100 stocks, 99 of them are going to go to zero, and one of them is going to go to 1,000, I think I could own that without any problem. But watching the details of that many stocks and knowing that so many of them have problems, I would get uncomfortable, and I to play the game all the way through, which goes back to my point. You have to stick with a style of investing that works for you, so that when everyone can manage any investing style when it's going up, but there are down days. We've had a couple good years here of late. This is October 2018, and it's been kind of a nasty month. But if you know what you've owned, it's not really that nasty. But if you don't know what you have, months like this can really cause you to hit the panic button. Mm-hmm. And in which case, you probably shouldn't be buying individual stocks.
Mm-hmm. So, Doug, this is one of my favorite questions, and you probably know what's coming. And really, what I want to know is, what experience would you say helped guide your microcap investing thesis?
I think learning that if you understand what you own, there's every reason to believe that you should actually do better in a microcap than in a large cap, because you're competing against a less sophisticated group of investors. Mm-hmm. If you're going up against Seth Klarman and Carl Icahn, really, you think you got an edge? So go where they're not. There's an old joke about Bobby Fischer, the chess champion. It goes around the lines of how do you beat Bobby Fischer? Well, you play him in anything but chess. And that's pretty much my view on investing alongside, Seth Klarman. Pick something else.
Mm-hmm. So I'm guessing you had an experience where you picked something alongside Seth and maybe didn't do as well.
Well, I was very fortunate. I got serious about my investing in the late 90s, and I was working in IT, and I was working alongside people who didn't know anything about investing. This was when I was reading all the Buffett books I could get my hands on. Mm-hmm. And they were all buying Syscom, Bay Bridge. Oh, God. I'm trying to think of the crazy names. Nortel, Pets.com. Anyway, the IT people all thought that they knew all the companies because they were using the products. And I was like, but these things are selling for 500 times earnings, and Cisco was selling for $500 billion in 2000. And I'm thinking it's going to take Sun Microsystems was going to take 25 years of accelerated growth to grow into its market cap. All these things died, and they were all investing in them, and I wasn't. And so they were my buddies were all making big money, and I was looking at classic value stocks in 98, 99, and 2000. And I had decent returns those years. But at that point, I was still staying in the large stocks, and seeing all the .com stuff crash and seeing the opportunities in the space that was ignored was a really a key lesson for me, which is generally you don't want to go where the crowd's going. So God bless those people who made money in crypto. There's going to be people who make money in cannabis stocks. God bless them, but it won't be me. On the flip side, I haven't lost a dime in crypto, and I'm not going to lose a dime on a Mary Jane stock. It's just not going to happen. And it's not about how much you make as much as how much you don't lose. If you don't lose any money, every time you have a 30% return, you're up 30%. It's not that hard to find things that will go up 30%. What's hard to do is to buy 20 stocks that you think are going to go up 30% without having a few duds in there, and those duds will really drop your returns. And so if you can keep the bad ones out, you'll do much better. The line, if you buy a stock for 100 and it drops 50%, it's selling for 50. To make that money back, though, you don't need a 50% gain. You now need a 100% gain. Mm-hmm. Well, those two X's, that's kind of nice, and they're a lot nicer if you can keep the whole 2X. So one of my sayings is, I don't want to buy anything that I wouldn't want to buy more of if it goes down. And it sounds kind of like, duh, of course, who wants to buy something that goes down? But there's certain companies that you can look at and you can say, if you woke up tomorrow and you saw the stock was down by half, could you have predicted it? And it's like, oh yeah, maybe it was a company that had one customer that was 2/3 of its business. And if you buy that company, there's an excellent chance that someday the largest customer will want to renegotiate its contract. And your company is going to get hammered. Would you want to, in advance that stock has a great potential for getting cut in half anytime that happens. The way to avoid losing half your money in that stock is to not buy it in the first place. And so that's what I try to do. So instead, if I buy things that I don't think are going to have that kind of a bad outcome happen, there's an excellent chance that if that stock goes down by 25% because the market's just being weird that day, or a large owner needs to sell out his position, or somebody accidentally hits a market order on a thinly traded stock, you have a great chance to go in and buy more. And so I don't like to buy things that I wouldn't want to buy more of if the price goes down.
Mm-hmm. So Doug, we're rounding the bend here, and I just want to make sure people know, where can my audience go and find more information about you and your blog?
I'm kind of a regular on the Buffett Munger circuit. So if you're out in Omaha or LA for one of the annual meetings, you probably see me out there. My blog, nocalledstrikes.com, I don't post as much as I should, but I do try to get something out there a couple times a year.
All right.
Most of the items have turned out fairly decent. And if you want to reach me, you go to like the About button on nocalledstrikes.com and this little contact page. And wish you well.
All right. Well, Doug, thank you again for joining me today. I really enjoyed our conversation, and I hope to see you soon out here in LA.
Oh, you bet. Take care.
Take care. Thank you all for tuning in to the Planet MicroCap Podcast, and thank you, Doug, again for coming on to the program. You can access the podcast by going on to StockNewsNow.com under podcast, go to Podbean.com and search Planet MicroCap Podcast, or on iTunes and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@SNN.Wire.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the MicroCap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone. Happy Thanksgiving.